Envision Capital joins us. Nilesh, good morning. Thank you for joining us. Nilesh, what do you make of Friday's mayhem? Do you think the trading regime has taken a 180-degree turn and it's no longer risk on or risk off? It is now fear which is clearly occupying the center stage.
Well, it's just a continuation of the downtrend that we have been witnessing now for many years. So I'd probably say that this is just one day which characterized a continuation of that trend. I think these fears and apprehensions are coming in from several fronts. Partly it is global to do with the way the QE3 is going to kind of unwind, but it's also got to do with a lot of concerns which are shaping up in the domestic and the local economy. And this is clearly where investors are having the biggest apprehension, that is the growth story of India. How is it going to shape up in the months and quarters ahead, especially as we get into an election year?
Nilesh, hi, morning. Since the rupee has not stabilized, are markets worried about more policy action?
Well, yes, I think clearly that's the biggest fear. That I think somewhere in recent times, the tendency to protect or stabilize the currency, I think, is kind of become the number one objective. That's especially what came out in the RBI's last credit policy, that clearly the priority number one was stabilizing the rupee and stabilizing the currency versus growth and inflation. And I think it's clearly from there on, has the apprehensions only got amplified, have the apprehensions got louder, that with this change in priorities, that's going to take a significant beating on both growth and inflation. And I clearly believe that that's clearly where investors are having the biggest apprehension about Indian equity markets, because Indian markets have been always about growth. And clearly at this stage, you're really not seeing growth going beyond that 4 to 5% level.
Nilesh, banks clearly have led the decline, but your view is that banks are in some kind of a structural downtrend and the pain for PSU banks and private banks is not over. So why are you convinced that the springtime for banks is over?
Well, I think clearly if you look at the entire banking space, for public sector banks, the big challenge has always been asset quality for last now few years. And I believe that that challenge or that risk, I think, is only going to kind of accentuate even from here. Because the way to look at the asset quality is not just the NPA levels, but the restructured assets. And if you combine the restructured assets and the NPAs, that number goes to about 10%, which I think is a significant risk for banks. And obviously that will require a huge degree of capitalization. The second big challenge which has emerged, or the big risk which has emerged, is essentially the northward movement in government yields, which is essentially going to bleed the investment portfolio. So I think clearly there are challenges both on the loan portfolio side as well as the investment portfolio side. On the private sector banks, I think you're now going to see challenges coming in terms of the business model. A few of these banks have been borrowing wholesale, borrowing short term and lending long term and lending retail. And you're going to probably see the asset liability mismatch kind of come to the fore, which will impact margins. But I think apart from that, the biggest concern that we've been having about private sector banks is the valuations. I think it's been ridiculous to kind of have these banks quote at 3 times, 4 times, 5 times price to book. And I think that clearly this is something which is not sustainable. It's something similar to the technology stocks in 2000, 2001, when they were trading at 50, 60, 70 times. We clearly think that private sector banks were trading at those kind of valuations. The recent correction, I think, is good, but I'm not too sure whether we are done with in terms of the readjustment of valuations which private sector banks need to get.
So where do you think banks will eventually settle? I mean, can they lose another 10 to 15% from the current levels?
I wouldn't rule out that possibility. It's quite likely, because I think some of these banks still are trading at yet about close to 3 times, or if 2.5 to 3 times. So our call is that probably some of these quality private sector banks which are large enough and are managing asset quality well could probably come down to about 2 to 2.5 times price to book, which obviously means that there could be a 15 to 20% correction. I think what we really need to watch out for is that in an environment where the GDP growth is 4 to 5% and there are challenges in terms of the performance of core sectors, in that kind of an environment, at what growth rate do these banks register? What are the kind of margins that they sustain? And I think the next 4 to 6 quarters are going to be very challenging. That doesn't mean, of course, we don't have trading rallies in private sector banks, but clearly from an investment perspective, I think we need to kind of really wait for not only just lower levels, but more stability in the macroeconomy.
Nilesh, but irrespective of the environment, IT and pharma stocks have done rather well this year. Let me give you some numbers. HCL Tech is up 48%, Sun Pharma is up 47%, and TCS is up by about 37-38% this year. Do you think this long pharma, long IT trade will continue?
I think that trade has still somewhere got a long way to go. More so on the technology side. Most of the technology companies are basically now reasonably optimistic on a relative basis going forward from a 1 to 2 year perspective. Given the fact that the rupee is weakened so much and the dollar is strengthened, I think gives serious tailwinds to most of the technology companies. It cushions them in terms of margin pressures or any volume pressures. Two is their ability to now go more aggressively after large deals, I think becomes even better. The US economy and the global economy seems to have come out of a recession, and technology spending, which has been subdued for many years now, is likely to revive. So all in all, I think there are strong tailwinds for the technology sector, and I think that's clearly the big trade one has to be focused on.
Nilesh, FIIs have not been big sellers up until now, but because of the recent underperformance, do you think outflows could now turn?
That will always remain a concern, and I think Indian and foreign investors have been overweight on India relative to a lot of the emerging market peers, particularly the BRIC peers, because India still, despite all the problems and all the challenges, still continues to look much better relative to Brazil and Russia. So I clearly believe that they will maintain their overweight stand. However, you could always see a process of portfolio reallocation where they could start shedding the positions that they have in sectors which have done well. And probably the moves that we've seen last week, say in the banking space, clearly I think is a manifestation of that move, that where they have concerns on select sectors in India, and probably those are the sectors which could basically have to face the brunt of selling by the FI. So it may not be an overall negative call on India by them. It may not be a shift from, say, overweight to underweight, but it could still be a shift from overweight to market weight, and a shift from private sector banks and sectors linked to the domestic economy to a shift towards the technology, pharma, and some of the more defensive sectors.
Nilesh, your fund has done exceptionally well in last 3 years. The mid-cap index is down by about 36-37%. Your fund in last 3 years is up by about 15-16%. So that's a great performance. So at the current juncture, what is your portfolio strategy?
Well, our portfolio strategy still continues to be overall pretty defensive. So I clearly think that we are still more focused on sectors like consumer, technology, and pharma. Our leading positions are on the consumer and the technology space, and I think that as a strategy will continue. However, we continue to be very watchful of quality infrastructure players, quality engineering players. We've been watching them now for a few years, but we still haven't believed that the worst is over for them. So I think in case if these stocks still correct, and if the economy starts doing better, then I think we would be inclined to buy into some of the quality engineering names. But we don't believe that stage has yet come. We still continue to look for value in technology, pharma, consumer, and maybe even media.
Nilesh, so is it time to buy into the fall, or is it too early to do that?
Absolutely. I still think that these are nice cliches to hear. But it's very difficult to put them into practice, and even if you put them into practice, the consequences could be pretty fatal. So you've got to be very, very careful about not just buying into stocks which are just falling. They could fall even further. So as I said, is that you've got to be very, very careful in this kind of an environment, and only buy into those kind of stocks where you're completely convinced about their fundamentals sustaining. And I think that's clearly the best strategy to have in these turbulent times.
Well, even though there is blood on the street, Nilesh Shah of Envision is of the view that it's too early to buy into the fall, because you will end up having a falling knife trade. Then, Nilesh, always a delight to have you on ET Now. I know it was a last minute request, so thank you for accommodating this interview request.